We have featured the biotechnology and healthcare sectors on several episodes of the Investor Insights series over the last 6 months. We think these sectors look particularly interesting at the moment, both from a relative valuation perspective against other areas of the market, but also given the potential for changes in market sentiment and turning points in the economic cycle. Following several years of what's been, frankly, mediocre, range-bound returns from these sector indices, representing notable underperformance of the strongly performing broader global equity market, which has clearly been driven forward by AI-related names, it is encouraging to see the biotech sector show signs of recovery year to date, with some performance catch-up and also a noticeable pickup in M&A. This week we discuss this and much more with Ailsa Craig, the lead manager of the London-listed International Biotechnology Trust. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co.'s Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In today's episode, we were delighted to be joined by Ailsa Craig from Schroders, the co-lead manager on the London-listed International Biotechnology Trust, ticker IBT. Ailsa's been involved in managing the 270 million market cap trust since 2006 and became lead manager alongside Marek Poszepczynski in 2021. In late 2023, the management of the trust transitioned to Schroders, with Ailsa and Marek moving to the asset manager, continuing to run the portfolio, and now sitting within Schroders' thematic team and supported by their broader healthcare analyst division there. The biotech sector has clearly faced several headwinds over the last few years, not least from the impact of the fundamental shift in the economic environment in 2022, stalling investment, and then the uncertainty caused by the change in US political administration. However, we think it's important to understand that this period has not coincided with any let-up in the level of innovation and advancement stemming from the sector in recent years, nor in any change to the structural long-term investment case for the sector. Top 5 pharma business Roche recently highlighted that despite the huge leaps forward we've made in the life sciences over the last decade, we still don't have approved treatments for around 90% of the 7,000 rare diseases known in the population today. And whilst categorised individually as rare, these diseases in aggregate affect over 400 million people globally today. The biotech sector is clearly at the forefront of developing innovative medicines and better diagnostics to address this. And we've spoken previously about how megacap pharma and biotechnology are very likely to continue shopping in this space to replenish pipelines and bring new innovation to market. We think a fund-based approach is highly appropriate for accessing the biotech and life science investment case, enabling investors to access a broad basket of opportunities and greatly reducing the risk and sensitivities around individual drug pipelines. Funds such as IBT are also run by specialist investment teams, and I'm sure you agree that Ailsa's expertise and experience in this space comes across very clearly in this conversation. This interview was recorded on the 21st of October. I hope you enjoyed the episode, and as always, please do get in contact with us if you'd like any further information or explanation on any of the topics discussed. Ailsa, good morning. Thank you so much for spending some time this morning for this, and how are you doing today?
Good, thank you. Thanks for inviting me.
No, not at all. So we've got this standard opening question to these, and what it aims to do is kind of get a bit of an insight into you and kind of how you go about your work, really. So we've been asking people if they can share an anecdote from a recent meeting or trip that they've had, or even just an article or book that they've read. Is there anything that you could share for us?
Absolutely, Gordon. So I was talking about this question yesterday with my co-fund manager, Marek. And obviously I can't talk about the whodunit that I'm completely engrossed in, but we were literally before this conversation talking about a medical journal article. And it was a study in diabetic mice that looked at the effect of giving them these, what everyone's heard of, GLP-1s, in protecting them from when they have a stroke or if they have a stroke in a neuroprotective way. And the study found that actually it improved the outcomes for mice that had stroke, diabetic mice that had stroke, if they were on these GLP-1s. And it made me think this is a great example because it's so topical and people are talking about it. And we are expecting the readout from Novo Nordisk for a trial called Evoke in the coming months. And so if it works, your listeners might hear on the BBC News, there's this trial that's read out. And the trial is testing GLP-1s in early stage Alzheimer's patients and seeing whether progression is slowed down on these GLP-1s. Now, I'm going to take a step back and talk about what's been going on in this space, just many of your listeners would be well up to speed. But these aren't new drugs. So GLP-1s were first launched 20 years ago in 2005 to treat diabetic patients. What's changed is that in 2021 and 2023, these drugs increased their label to include weight loss in obese patients. And then the real kicker was a cardiovascular outcomes trial called the SELECT trial in 2023, run again by Novo Nordisk, that showed that the risk of heart disease or heart attacks rather than strokes was significantly reduced in obese patients that were on these drugs. And so that pivotal moment meant that this is no longer a lifestyle indication. This is actually a disease and preventing serious heart disease outcomes. And so therefore the system, all health systems felt the need to reimburse these drugs. And that's what's pivoted the whole market to take a look and sit up and see what's going on here. And if we see in the Evoke trial a slowing of progression in Alzheimer's patients, that's a massive benefit to society. So when you think about healthcare systems and the cost burden that we're facing, nursing homes is a huge part of that. And so by increasing the time of patients that can remain at home and not need nursing care would be a massive benefit to the healthcare systems that we know are already under pressure. So your listeners hopefully listen out for the Evoke trial results. You won't hear about it if it fails, but if it succeeds, this could be a real game changer in this GLP-1 space. And just to remind your listeners, at the moment, many decades and dollars have been spent in investigating treatments for Alzheimer's disease, and nothing's really worked until quite recently a new drug was launched, which means taking an Alzheimer's patient into hospital and having an infusion. And anyone that's had elderly parents or knows people with Alzheimer's, moving a patient into hospital is no mean feat. And moreover, once you're in hospital, you're exposing yourself to further illnesses like infection, etc. So it's not great. Plus, the efficacy hasn't been that impressive, and the side effects aren't insignificant. So this is an oral version of the GLP-1 that Novo is looking at. Having a tablet at home that could delay the progression of Alzheimer's disease is a big thing. It's big news. So this all stemmed from the article we were reading yesterday, how these GLP-1s might even help stroke patients potentially in the future. So there's lots of exciting things happening in this area. But I should caveat, GLP-1s cause weight loss. And the last thing you want in elderly people is weight loss. They can fall over, and falling is we all know is dreadful in that age group. So to be able to nuance this, I think the pharma companies, biotech companies, emerging biotech companies are looking at how can we get the GLP-1s through the blood-brain barrier. So you could give them a low-dose GLP-1, therefore not causing weight loss, but have the potency in the brain where we're seeing this effect, this neuroprotective effect. And, that could be the next leg of an indication for these drugs.
Yeah, absolutely fascinating. Yeah, definitely a trial we'll be keeping an eye on from now on. Yeah, thank you for flagging it. And Ailsa, I wondered if to kick the discussion off, whether I could ask maybe we'll dive into kind of some more specific areas of the portfolio in your universe a bit later. But I wondered if I could ask you just for kind of a broad view on your space at the moment. It's obviously been a pretty challenging period for biotech, and a number of parts of wider healthcare, really, particularly when a lot of the kind of broader technology space has been roaring away with the AI theme. Could I ask you to kind of talk about how you're viewing valuations and that kind of broad opportunity at the moment?
Sure. So you're absolutely right. We've been in a sort of protracted bear market, the longest it's ever been. Biotech does go in and out of favor. It's happened before multiple times. I've been following these stocks since 2000. When I first joined in 2001, we were coming out of a bubble at the time. And we've had various different cycles since. The current one, however, we peaked in COVID, the biotech sector in 2021. Valuations became very bubbly. And it was actually the year that Marek and I took over as co-lead fund managers of the trust. And we felt that things looked quite expensive. So we tilted the fund into the later stage profitable companies, of which there are many in biotech, and managed to kind of preserve capital on the resulting correction in valuations. And we do that. We manage the fund on a top-down and bottom-up basis. Then we were hit with rising interest rates. And this sector is, if you like, long-dated assets. So you develop a drug and then you're going to get sales in the future. So rising interest rates means that valuations go down today if you discount back those cash flows. So we had rising inflation, rising interest rates, and biotech couldn't recover. It found itself having another leg down. And then as Trump won the election, everyone got excited because the last time he was in power, this sector was up 40%. He tends to be seen as investor friendly. The expectation was he would appoint someone at the head of the Competition Commission, the FTC, that might be more investor friendly in terms of mergers and acquisitions, which is a big theme in our sector and always has been. So people got excited at that period, the end of last year. And then we were hit by the news coming out of the HHS, which is headed up by RFK, and some turmoil within the FDA. And so that was the third negative impact on the sector. However, this year, a number of those issues are now, we feel, behind us. So, for example, rates have normalized, valuations are looking much more reasonable, and the politics was still in a little bit of flux on MFN and tariffs. And we can come on to that later. But certainly with the regulator, which affects our stocks, that has seemed to be improving markedly since the initial appointments made by the Trump administration. And the result is we've seen year to date, our index up 21%, the NBI, this kind of SMID cap weighted index, biotech, is up about 20%. The S&P is up 15%, and the NASDAQ, broader NASDAQ, 18%. So biotech is outperforming, and our fund is actually up 30%. So this year, despite what's been going on, we are seeing a recovery. And I imagine there are people thinking, right, do we want to move out of AI or tech, and looking at the sector and seeing how the valuations are looking pretty depressed and nibbling away.
Yeah, thank you for that. And you mentioned there about kind of managing the portfolio top down slightly and moving it previously into kind of larger companies as a bit of a kind of safe haven area. But if you're kind of tracking the fund over the last several years, and we'll often show a kind of style grid in our research notes, which I know is a kind of simplified way of looking at a portfolio, but it's quite good at kind of showing a snapshot through time. You can see that progression towards, on average, allocating to smaller size businesses. And that's a kind of feature that you've referenced in your commentary several times kind of recently. Could I ask you to kind of talk us through the extent to which you've changed that and the kind of rationale behind it?
Absolutely. So what we're seeing is the inverse of what I spoke about in 2021, the SMID cap market. And I'm going to caveat this because we say SMID, these are large companies.
Sure.
There's sort of most of the companies where I'm going to talk about are between, say, 2 billion and 5 billion market cap. They're not white coats, early stage biotech. These are often on the cusp of commercializing a drug. So, but that's where we think the sweet spot is right now. And like you said, yes, we do top down and bottom up. So we have tilted the fund a year or so ago. It's been a while. And I think that's what's benefited performance. We outperformed over 1, 3, 5, 10 years, and especially year to date on the back of that sort of decision. That on the other side of that, large cap companies have been quite overcrowded in our view. So they're looking quite expensive on a price to sales basis relative to the mid caps that should have a lot higher growth. So we're very excited about the positioning where we are and looking forward, think that that could reap some good returns. And another just factor to kind of drill home the size of these companies, the biotech sector in the US has matured over the past 25 years considerably. It's very not really like that in the UK and Europe. The industry is very dominated by the US. And one of the larger companies that I'm referring to is called Gilead. Their market cap is $150 billion, whereas Glaxo, that we're all familiar with, is $60 billion. So these are big pharma-like companies within our index.
Yeah, no, absolutely. A really important point. I wondered if we could kind of drill down into some specific areas just to kind of give the listeners a bit of a sense of kind of what they're gaining exposure to here. Are there kind of noteworthy therapeutic areas or kind of segments of your universe that you're currently kind of biasing the portfolio towards it? And are there any areas that you're avoiding? It might be quite interesting to kind of see what you're not touching at the moment.
Absolutely. So this leads on from the previous answer, which is we think what we're seeing, because there hasn't been much M&A. There has been recently, but over the period of time when Nina Khan headed up the FTC, there was pharma sort of stepped back a bit from M&A. COVID prevented management teams meeting, etc. And since then, there's been a bit of an uncertainty about what the rule book is in terms of the regulator and tariffs, etc. And now we're suddenly seeing a rush. And I know we're going to come on to M&A later, but where we're positioned is in what we call biotech 2. So 10, 15 years ago, 20 years ago, when the Gileads and the Amgens and the Biogens were emerging biotech companies, they launched drugs on their own. They benefited from a very high growth in sales, and then they turned profitable. And what we see now in biotech is a maturing of the industry. There are multiple biotech companies now that are either just launched or they're filed at the regulator or about to launch. So they're clinically de-risked. They've got through the clinic and that risk is behind them. And now it's purely sort of regulatory and launch risk. And we put a third of the fund in that. And so that these names are not sort of blow up due to a clinical outcome anymore. It's really, you can capture the growth of a launch. And we think also that's where pharma's shopping. So the index has 7% exposed to those particular names, and we have a third of the fund in those names. So that's the area we're most excited about, this biotech 2, the next generation of high growth, potentially profitable companies. And we're avoiding the large cap names. Like I mentioned earlier, we feel that the valuations are quite high versus their growth rates. You know, these guys having the same problems that pharma are having. They're facing patent expiries. Their top line growth is struggling. So we're avoiding those areas. We'll occasionally have them in the fund, and you might see one pop up in the top 10. But our exposure is in this biotech 2 segment of the market.
Yeah, thank you for that. It really explains kind of how you actively kind of move the portfolio around. Yeah, absolutely. Jumping around a bit here, but I wonder whether I could ask you to kind of talk through how you kind of use the investment trust structure. We talked a lot in the series with managers of a variety of trusts about the investment trust structure, the kind of closed pool, and kind of how you can implement a strategy in kind of less liquid or even unlisted investments. Could I ask you to maybe talk through how you guys kind of benefit from that structure?
Absolutely. So the fund was founded in 1994, so it's 31 years old now. And it was originally started as a way for UK investors to have exposure to this exciting new sector called biotech, from unlisted companies all the way up at the time, obviously not very mature companies, for widows and orphans, basically. And so they thought, let's put it in an investment trust structure because the sector itself is inherently risky, at least at the time it was. Now, the advantages of this structure is, like you say, it's closed-ended, and we can pay a dividend, which we do out of capital, which is 4% of NAV a year. and the dividend yield on share price is even higher because obviously we're at a discount right now, it can allow a sensible way for UK investors to access the venture part of the market, which has historically given us very strong returns, more than the public markets. But we keep it as a sort of sweetener. And this is a board decision, not a management decision. So between 5 and 15% of the fund, and it's currently around kind of 8-9%, is a kicker to performance. And the other advantage is we can gear. Now, this is a very useful tool in our toolbox, if you like, because of the volatility we see in this sector. We can gear up or take gearing off. So around April time, we had Liberation Day. Now that hit all equities, but biotech was hit harder because of the turmoil in the FDA and news flow coming out of that, cuts at the regulator, and some staff changes that sent concerns into the industry and the investment base because they weren't sure about what the rulebook was. And so we geared the fund to approximately 20%, and that's the highest gearing position you've had since 2008 when Bear Stearns blew up. And we had that much conviction, and that's helped us outperform coming out of those lows. So you've got dividend out of capital. Our companies don't pay a natural income, but we get so much M&A. The way we explain to our shareholders is we get cash in from an acquisition, and we can pay part of that back out to shareholders. So gearing, we're at a discount as well. So instead of an open-ended fund, you're getting the biotech, but at a 10% or 9% discount.
Yeah, no, absolutely, all important features. Also, I wonder if we could go back and talk about US policy. I mean, it's the kind of big topic of the year, I guess. Impacts in this space. You mentioned the impact of ARCA earlier. There's an awful lot of news flow around this at the moment, but I appreciate it's quite a big question. But could you maybe summarize how you're currently viewing kind of policy changes and the impact on the biotech sector, particularly?
Absolutely. This was the third punch, right, to the sector that I spoke about at the beginning of the podcast. And fundamentally, what's happened is investors hate uncertainty. And the reason we're seeing this recovery recently is because we're beginning to get clarity on what's going on here. So back in April, I mentioned the regulator changes, some personnel left who were considered industry friendly, and people were worried about who they would be replaced by. Those concerns we feel have abated. They've definitely lessened. The people that have gone in have been meeting CEOs of biotech companies. Marty Macri, the commissioner, has introduced a new priority national voucher whereby companies can apply for the voucher and speed up the time it takes to approve a drug from 10 to 12 months to 1 to 2 months. So the FDA feels like concerns there are abating. The other issue is MFN and tariffs, so drug prices and tariffs on the industry, and they're interlinked because it's a negotiation. And why have we seen the sector, healthcare more broadly, rally recently? It's because we're seeing deals with the administration. So Pfizer and Astra have both struck deals with Trump, whereby they can sort of push out tariffs for a certain number of years. They're going to start manufacturing more in the US in exchange for negotiations on drug prices, etc. So this yin and yang. We don't know the full details yet, but we do know that issue isn't an overhang anymore. We're seeing clarity. We're seeing deals get done. And we expect a third deal in the coming days with another major pharma company.
So you mentioned M&A earlier as well, and I wonder if we could maybe go into a bit more detail there. I mean, it's obviously, as you referenced, really significant feature of the biotech sector, and something that you're kind of targeting even more with that kind of smaller company exposure. But how do you rate the prospects there? You mentioned the kind of patent cliff, but are you able to kind of give a bit more colour to that?
Absolutely, and I'll drill down a bit more on the patent cliff. So we always happens. You get these waves of patent cliffs. It happened in the noughties, etc. And the industry responds by, or at least in the past, consolidating is one idea. That's why lots of companies have all these double barrel names like GlaxoSmithKline, Bristol Myers Squibb. All of the, that's born from consolidation. This patent cliff we're facing is huge. So the branded drug market in the US is about 500 billion, and over 200 billion are coming off before the end of the decade off patent. So that the farmer's back's against the wall here. Parallel to that, they've been reducing investment in their own internal R&D. And that's borne out now on where the innovation's coming from. So last year, 70% of the new drugs approved by the FDA emanated from biotech companies and only 30 from internal R&D at pharma. 10 years ago, the inverse of that was true. 70% came from internal R&D at pharma and the delta out of biotech. So biotech's taken the role of innovating drugs, which makes sense, right? So innovation tends to come from universities, that small companies bud out of universities, they get venture funding and they list. You can't force a group of scientists to invent something. So it all adds up and makes sense. You can see why they're cutting back on R&D and maybe focusing on distribution and marketing, which they're very, very good at. So with that dynamic in mind, it's no surprise that you're going to see consolidation in terms of buying up biotech companies. They've got a problem with their top line. And there's a lot of companies out there that are mature, like I mentioned earlier, that were already launched, many of them, or they're at the regulator. So it's a real hunting ground for pharma to go and pick up revenues that they so desperately need. What we do at IBT is we look for characteristics in our companies and our investments that are the same as what pharma looks for. So we don't go looking for M&A candidates. It's just the same mindset that we have. And Marek, who's my co-lead fund manager, comes from a biz dev background in the industry and has worked and done these deals on both sides of the table. So he really understands how pharma thinks and how they value companies. And all of that has meant that we've had 33 acquisitions out of the trust since 2020, and we've had 8 this year alone. So things do feel like they're picking up on the M&A front.
Yeah, absolutely. Interesting. Also, you can't have an investment call without talking about AI, regardless of what sector you're talking about. And I wondered if I could kind of get your take on things. We often get asked about healthcare and biotech. A lot of people say it's a sector which clearly can benefit long term from AI. But I wondered whether you had a take on kind of how you foresee technological change kind of impacting your space, and whether there are any examples in your universe that are kind of early adopters of this kind of use of increased computing power and AI.
Yeah, I mean, machine learning, so you could call it sort of early AI, has been part of drug discovery in the sector for multiple years. What AI we think will do is improve the efficiency and the time it takes from drug discovery all the way up to giving a patient a drug. And I'm going to go through those steps and talk through how that will work. So ultimately, drug discovery, screening lots of compounds, ditching compounds that may have a tox effect that might have come up in a previous trial, that's all got its role. So maybe we could get sort of better targets into clinical development faster. And then once they're in clinical in phase 1, 2, or 3 trials, AI could help with looking for patients and recruiting patients to those trials. Once the data's read out, crunching the data and understanding what signals they're seeing. It can help with the regulator. The regulator is trying to reduce the need for animal testing, for example, and replace it with AI models. And then post-approval, again, in the launch, looking for patients, diagnosing patients, and that's really key. So instead of one pathologist looking down a microscope, you can compare a slide with multiple different other breast cancer patients, for example, and look for any signs of tumors. And then manufacturing can be improved in efficiency, reducing the need of lots and lots of sort of humans needing to get a drug manufactured. So lots and lots of areas where things can become more efficient and hopefully maybe reduce the time to get a drug to market. What it can't do is replace clinical trials. The reason we do clinical trials is because we don't know the answer. We don't know if it's efficacious. We don't know if it's safe. And AI is based on data that we do know. So that it's not going to game change that sort of part of the drug approval process.
Yeah, really interesting point at the end. Yeah, thank you. Ailsa, a bit of time here at the end. We've got a standard final question here as well. And it asks for the speaker for one particular area that they would highlight at the moment, kind of a high conviction area or something that they're really positive on. You've mentioned a few areas already, but I wondered if is there one particular area of kind of biotech innovation that we haven't spoken about, or an area that you're excited about?
Yes. And so another thing we've done in the fund is we've moved into something called rare diseases. And I'll explain why. But just to take a step back, a rare disease is something that affects not very few patients in the US or Europe or globally. But they can often be incredibly severe, and often they affect children. And they're well understood biologically, however. So all of the new technologies that have come about over the past 2 decades in biotech, like gene therapies or CRISPR or RNA interference, etc., they're sort of very useful technologies that could potentially be part of a drug to treat these rare diseases. So we've tilted the fund in this area because we think it's particularly exciting. A lot of the diseases have absolutely no treatments. The trials themselves, because there are not very many patients, are quite small. So biotech companies can run the trials and they don't need pharma partnering. You can launch these drugs on your own. So a lot of biotech companies have focused their efforts in this space. And then more recently, Marty Macquarie, who I mentioned earlier, the commissioner of the FDA, has introduced a priority national voucher system whereby biotech companies can apply, and pharma, anyone can apply for this voucher, and it will reduce the time it takes at the regulator. So I was saying 10 to 12 months to get a drug approved to 1 to 2 months. And when you think about it, IP is approximately 10 years once a drug is on the market. You can add another year to that. That's a huge impact for the company in question. So we like this area. We think the biology is well understood. It's a high unmet medical need. And so we've got a decent proportion of the fund in these stocks.
Also very, very interesting. Thank you so much. Always really fascinating chatting to you and getting your thoughts. Appreciate your time today.
Thanks, Gordon.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.